Hello, I'm Brent Joyce, Chief Investment Strategist at BMO Private Investment Council. It's Friday, March 1st. Welcome to our Global Markets Commentary. February brought a continuation of largely good to Goldilocks, not too hot, not too cold, macroeconomic data. The fact that the macroeconomic backdrop continues to improve is quickly becoming the consensus view. Recession calls continue to be ratcheted back, and those sticking to that narrative, they're having a tougher time finding justification. In fact, those calling for a recession might have missed one right under their noses. We have subscribed to the idea that the past 2 years have seen recession-like, or recession-light, if you will, conditions in many places. What has come to light in early 2024 is that many countries were closer to recession conditions than we thought. Germany, France, the UK, Japan, here at home in Canada, and China all put in weak showings in the back half of last year. What we believe we have now is the exit from these rolling recessions. Stock markets are reacting to these developments, with most global markets posting gains, some quite sizable. Japan and China up 8 and 9%, US and Europe both up 5% in February alone. Stock markets lead the economy, and they are forward-looking. So stocks are off to a good start in 2024 because there are many positives on the horizon. Housing looks like it's finding a bottom, manufacturing indicators are pointing up, credit conditions are improving, borrowing costs are off their highs, and global trade is picking up. This is leading to upward revisions to the outlooks for global economic growth and in turn corporate earnings. All of this means we're in a good place. And when you're in a good place with lots of cash on the sidelines, stock markets go up. The rapid rise of equity markets continues to bring out the so-called recessionistas, sounding the alarm that stock markets are well ahead of themselves. And people are making comparisons to 1999 or 2007. We think these are false alarms and that such comparisons are misplaced. When we walk through a checklist of conditions that prevailed in those prior bubble peaks, we find scant evidence that those conditions are repeating themselves today. We've not had extended and excessive equity market gains. This is often referred to as a market melt-up or a blow-off top. Stocks are just making new all-time highs now. By definition, that means most have gone nowhere for 2 or more years. Can you really have a blow-off top when you have only just recovered from the prior market peak? We'd argue no. There have not been massive inflows to equity market mutual funds and ETFs. This signals recklessness and the fear of missing out or manic buying. There have been solid inflows to stocks, but they're eclipsed by money pouring into money market funds, leaving all that cash on the sidelines to fuel further equity gains as we move forward. How about mergers and acquisitions mania? Nope. M&A activity is picking up, but buying any company at any price with all stock and no cash based on pumped up share prices like we had in 1999, that's not happening. Manias and bubbles come after earnings have been strong, and analysts are scrambling to raise their forecasts month after month after month. Corporate earnings revisions are just getting started at turning higher. Now, there's a lot of consternation over the handful of mega cap companies driving the US stock market, and that has been true. However, the Magnificent Seven is now the Super Six, as Tesla has faltered. Furthermore, Apple and Alphabet shares haven't gone anywhere for 6 months, but the broad equity market has advanced. Of course, Nvidia is a big part of this, but why not? It's delivering spectacular earnings and earnings growth. The reality is, a healthy number of stocks, over 70% by one measure, are demonstrating positive momentum. This is evidence that the breadth of the stock market rally is much greater than the headlines would suggest. Similarly, the bond market isn't signaling weakness ahead. Bond yields are up some, and the corporate debt market remains stable. Even shudders in commercial real estate that rocked New York Community Bank did not amount to any contagion. Now, we're not suggesting that today's markets can't stumble. That can happen anytime for any number of reasons. Seasoned investors know stock market corrections in the 10% range generally come along every 8 to 18 months. So after the substantial and uninterrupted gains we've had since October, it would not surprise us, nor really be an unhealthy development, for some consolidation of those recent gains. Importantly, though, we don't see the makings of the colossal declines that marked the 2000 and 2008 episodes. Stocks aren't cheap, but why should they be? Interest rates, earnings growth, and sentiment all drive stock prices from time to time. And valuations are a mixture of these ingredients. The most powerful driver of the three is earnings growth. We may not like paying up for stocks, but paying up for earnings is a much more comfortable place than paying up solely on the hope that interest rates fall or sentiment remains ebullient. We are very constructive on earnings growth. We also happen to think that interest rates and sentiment can support stocks in 2024 too. That's the way we saw the month of February. Thank you for joining us. We look forward to you tuning in next month.